In retirement, minimizing capital gains taxes can significantly boost the amount of money you can actually spend and enjoy. But figuring out how to legally reduce those taxes can be tricky, especially when the stakes are so high. If you're wondering how to reduce your tax burden without sacrificing your income or lifestyle, you're in the right place. Stick around, because I'll walk you through the most effective strategies to minimize capital gains taxes in retirement. And by the end of this video, you'll have a better grasp on how to preserve more of your wealth for the long term. Before we dive in, if you're serious about protecting your wealth in the next 2 weeks, click the first link in the description below to get a free guide on why thousands of Americans are turning to gold IRAs to safeguard their savings. It's a simple strategy that can help you minimize taxes, and we'll get into how it works shortly. Now, let's break down how you can minimize those capital gains taxes. One of the easiest ways to minimize capital gains taxes is by holding onto your investments for the long term. The IRS rewards long-term investments by offering a lower tax rate on assets held for more than a year. While it may sound like a simple concept, many retirees sell their assets too soon, triggering higher short-term capital gains taxes, which can really eat into your profits. By simply holding on to assets longer, you can take advantage of long-term capital gains tax rates, which can be significantly lower than short-term rates. Another strategy is tax loss harvesting, which can be a great way to offset gains with losses. Essentially, you sell losing investments to offset taxable gains from other investments. The best part? If you're in a taxable account, the losses can be used to reduce your taxable income, and they can even offset up to $3,000 of ordinary income each year. This is a valuable strategy, especially for those with significant investments, like real estate or stocks, that have appreciated in value over time. But remember, this is only effective if you're using taxable accounts. If your money is tied up in tax-advantaged accounts like a 401k or an IRA, this won't apply. For those with sizable savings, especially American retirees with 100k plus in your IRA or 401k, a strategy you'll want to seriously consider is converting some of your traditional IRA or 401k funds into a Roth IRA. This allows you to pay taxes on the money now at potentially lower rates and then enjoy tax-free withdrawals in retirement. If you're planning to pass on wealth to your heirs, a Roth IRA can also be a huge benefit since they'll inherit it tax-free. The key here is understanding that the IRS offers you the opportunity to grow wealth in tax-free vehicles, but only if you get it in there now before tax laws change. Speaking of tax-advantaged accounts, the Gold IRA is quickly becoming one of the best options for retirees looking to diversify their wealth and minimize capital gains taxes. Gold IRAs provide a way to invest in precious metals, which often rise in value when inflation is high or economic uncertainty is present. The best part is that, just like any other IRA, Gold IRAs allow your investments to grow tax-deferred until you're ready to withdraw in retirement. So if you're serious about protecting your wealth and ensuring you don't overpay in taxes, Gold IRAs are worth considering. Another great way to minimize your capital gains tax exposure is by taking advantage of the 0% capital gains tax rate. This rate applies to people in the lowest tax brackets. So if your income is low enough, you may qualify for tax-free gains. To take advantage of this, you'll need to manage your taxable income carefully. One way to do that is by utilizing a strategy like qualified charitable distributions, QCDs. If you're charitably inclined, QCDs allow you to donate directly from your IRA to a charity and bypass paying taxes on the distribution. This can be especially useful for retirees who are looking to give back while keeping their tax obligations as low as possible. Real estate is another area where retirees often find themselves paying unnecessary capital gains taxes. If you've held on to real estate for a long time and it's appreciated significantly, the IRS can take a large chunk of your profits when you sell. But there's a strategy to reduce those taxes. Consider using a 1031 exchange. This allows you to defer paying capital gains taxes on investment property when it's sold, as long as the profits are reinvested into a similar property. It's a great strategy for real estate investors looking to preserve their wealth while avoiding hefty tax bills. Lastly, consider the tax impact of your withdrawals. For those of you with large retirement accounts, it's critical to be strategic about how and when you withdraw funds. Taking money out of your retirement accounts before you reach the appropriate age can result in steep penalties and taxes. Planning your withdrawals carefully, possibly using a combination of taxable and tax-deferred accounts, can help minimize the tax impact on your retirement income. If you want more guidance on these strategies, especially on how to use Gold IRAs to protect your wealth and minimize taxes, click the first link in the description. It's a free guide that can make a real difference in how you protect and grow your wealth in retirement. This strategy is perfect for American retirees with 100K or more in your IRA or 401k, or even 5M plus in savings, looking for tax-efficient ways